Are you worried about the banks collapsing and your money disappearing? Facing an economic downturn can be a scary time, but there is an alternative to banking that can protect your investments against external threats and economic instability. Investing in tangible assets such as real estate, gold, silver, and precious art can provide powerful protection against unexpected financial shocks, while still offering returns on investment opportunities. In this video, we'll see how and why banks are collapsing, and how customer assets in these banks are in danger. And alternately, how you can make safe investments to keep your money safe during this global recession. We'll also look at some of the advantages of investing in these tangible assets, such as the potential for appreciation, rental income, inflation hedge capabilities, and more. The collapse of the Silicon Valley Bank, SVB. Silicon Valley Bank, once a powerful and reliable banking institution, is now facing a complete collapse. This is due to an inadequate risk management system and a lack of financial oversight that has allowed asset values to rapidly diminish and investors to lose their money. The bank's total assets have plummeted from $4.9 billion at the end of 2019 to just under $1 billion in 2020 as investors flee in droves. The FDIC admitted in a private meeting that the bank was not adequately capitalized, meaning it did not have enough reserves on hand to cover its liabilities. Investors who had long relied on Silicon Valley Bank for safe investments are now finding themselves without any of their hard-earned money. In addition, the banking industry has been rocked by the news that the Treasury Department is considering taking over some banks in order to prevent further collapse. The collapse of Silicon Valley Bank marks another dark chapter for the financial industry, following years of mismanagement and lax regulation. The lack of oversight allowed risky assets to be overvalued and left investors with large losses once those assets started dropping in value. It also leaves many without access to their money, since in many cases, they need to wait until the bank can transport funds from its central location before they can get them back out again. The real danger here is a contagion factor. As more investors withdraw their funds from Silicon Valley Bank, the risk of a financial collapse spreads throughout the industry. It's a domino effect, where one bank's failure can lead to a cascading failure of other banks. The FDIC's inadequate capitalization means that if multiple banks fail, they could have difficulty recouping all the money they're obligated to pay back. This makes investors leery of investing in other banks, leading to withdrawals and further erosion in market confidence. The fragility of the banking system is causing even more concern as governments around the world take steps to contain the economic fallout caused by COVID-19. In response, some countries are imposing capital controls, preventing citizens from withdrawing their deposits and transferring them abroad. This has caused runs on some banks in Europe and Africa, and there is a fear that similar runs could begin in America if customers don't feel like their money is secure. In response to this, the Treasury Secretary has been working with the banking industry to ensure that banks are properly capitalized and have adequate reserves on hand. The Secretary recently issued an update on their efforts, outlining new measures they'll be taking to prevent further collapses in the sector. In order to strengthen the financial system, the Treasury Department is introducing a series of measures which include increasing capital requirements for large banks and instituting stress tests for all institutions. These measures would help ensure that banks have enough money set aside should there be any unexpected losses or declines in asset values. In addition, the Treasury Department is also looking into ways to improve risk management systems so that investors can better protect themselves from losses due to mismanagement or other external threats. Finally, the department is also pushing for more oversight of financial institutions by regulators such as the FDIC and SEC in order to prevent future collapses like what happened with Silicon Valley Bank. They're also advocating for greater transparency when it comes to disclosing information about investments so that investors know exactly where their money is going and how much risk they're taking on at any given time. But it's still unsure that these steps taken by the Treasury Department would ensure investor protection and financial stability in the long run. The current global economic situation and the impact it's having on banks. The current global economic situation is having a devastating effect on banks and other financial institutions, particularly due to the rapid disappearance of their money. This has been caused by a number of factors, including the increased volatility in markets due to the pandemic, rising unemployment rates, and a decrease in consumer spending. The result is that banks have less money available to lend out to customers, leading to an overall decrease in liquidity, which affects both individuals and businesses. Banks are also facing rising default rates as more people are unable to keep up with their loan payments or credit card debt. Additionally, banks' investments in risky assets have become increasingly uncertain. All these factors contribute to a decrease in profits for banks and an overall decrease in bank deposits. The impact of this situation on banks is significant as it leads to higher levels of insolvency. As banks lose money due to loan defaults and investments go bad, they become unable to meet their obligations and may be forced into bankruptcy. This can cause a ripple effect throughout the economy, as other businesses may suffer from decreased access to capital or even collapse if they rely heavily on funds from affected banks. Banks may also feel pressure from investors who demand higher returns or pull out of investment altogether if they feel that the risk associated with banking activities outweigh potential gains. In addition to these negative effects on individual banks, the disappearance of money can have far-reaching implications for entire economies. In cases where large amounts of bank deposits are lost or frozen due to insolvency or fraud, entire countries can suffer from financial crises that lead to recessions or depressions further down the line. The dangers of investing in banks and the many types of risks associated. Banks have become known for taking risks with their investments, and many people have seen the result. When banks fail, people's money suddenly becomes inaccessible and can disappear without a trace. When a bank invests in a risky asset, they're taking on debt that may not be able to be recouped if the asset doesn't pan out as expected. This could lead to a rapid decrease in the value of the bank's assets, putting its customers' funds at risk. Even as recently as 2008, America saw this phenomenon when banks collapsed from bad investments and risky loan practices. Customers who had their money stored at these institutions were left with nothing but broken promises and empty accounts. Not only can banks fail due to poor management decisions, but cybercriminals can also target financial institutions for malicious purposes. In 2017, hackers stole over $81 million from Bangladesh banks' accounts at the New York Federal Reserve Bank by exploiting weaknesses in its security system. If a bank is targeted by hackers or is unprepared for such an attack, it could risk its customers' funds being stolen or lost forever. In addition to these risks, governments around the world can also take control of citizens' funds during times of crisis or political unrest. During periods of hyperinflation or extreme economic turmoil, people may see their savings disappear overnight due to government-sanctioned currency devaluation or banking regulations meant to stabilize markets or address social needs. Ultimately, investing in banks has become increasingly dangerous in today's world due to various factors that can put people's hard-earned cash in jeopardy. Investors should consider diversifying their portfolios by investing in tangible assets like real estate, gold, and silver so that their money is better protected from external threats and economic downturns. The solution for the failure of banking systems worldwide. The solution to this problem is simple. Invest in tangible assets instead. Tangible assets such as real estate, gold, silver, and precious art have been proven over centuries to be reliable investments that are often immune to external threats or economic downturns. Real estate is a great investment option because it is not only a physical asset but also provides rental income and has the potential for appreciation. Gold, silver, and other precious metals are also reliable investments that can act as an inflation hedge against rising prices. Precious art can also offer investors a chance to diversify their portfolios with something unique and the potential for strong returns. These tangible assets also provide investors with an alternative to traditional banking products, such as savings accounts or certificates of deposits, CDs. By investing in tangible assets, investors can gain access to their funds without having to worry about them suddenly disappearing due to bad management decisions or an external threat such as a cyber attack. Additionally, these investments can often provide peace of mind due to their lower volatility compared to stocks and bonds. Overall, investing in tangible assets is an excellent way for individuals to protect themselves from financial catastrophes like the collapse of Silicon Valley Bank. Tangible assets have low risk and provide long-term stability, which make them ideal for both novice and experienced investors alike. Real estate has been a reliable asset for centuries, with some properties still standing after hundreds of years. Gold and silver have also been around since ancient times and are still used as currency today. Precious art is another tangible asset that has endured throughout the ages, with pieces from thousands of years ago still being admired and appreciated by collectors today. These assets have proven their worth over time, providing investors with stability even during periods of economic turmoil or political unrest. For example, gold was one of the few investments to appreciate in value during the Great Depression, when stocks were plummeting in value. Similarly, real estate held its own despite market crashes such as the 2008 housing crisis, due to its inherent physical value and potential for rental income or appreciation over time. Additionally, these assets can provide protection against inflationary pressures, which can erode savings accounts or other paper-based investments over time. Gold is particularly effective at this due to its limited supply, which helps it maintain its purchasing power better than fiat currencies like the US dollar, which can be printed in large quantities without any underlying asset backing them up. In conclusion, by diversifying your portfolio with these tangible assets, you can better protect yourself from external threats and financial catastrophes that can lead to disappearing funds. Tangible assets are great for people seeking long-term stability and peace of mind when it comes to protecting their hard-earned money. If you enjoyed this video, be sure to like and subscribe to the channel for more things investing and personal finance.